Well, good evening, everyone. My name is Robert Friedman. I'm the founder of Cannabis Lab, Law, Accounting, and Business. It's not often I'm your host, but I'm glad to see you here tonight. Just a couple of news and notes before we get started. If you've never heard of Cannabis Lab, we're a business networking organization for professionals who are looking to get into this industry or who are already in this industry and looking for resources and solutions, and certainly to network and be educated about the issues that are going on in this industry. Every year, we cover several issues that seem to pop up over and over again. They're not going anywhere, whether it's banking, shadow banning on social media, and certainly the risk issues associated with the cannabis industry. We're very lucky to have as partners since we've started the Rons, Eric and David Ron of S2S Insurance, who have really helped to guide and lead our way in the space of risk management and insurance issues. They're our hosts for tonight's panel. We're glad to have them here. A couple things, news and notes before we get started. We do these events every month. Obviously, we do cover the issues that are important to the industry, and we hope all of you will get involved. But every once in a while, we do fun events as well. So next week, as I'm sure everyone on this panel and in attendance knows, is 420. If you are in South Florida, we do have an event here in Fort Lauderdale. We are returning to live and in-person events in Florida because we can. And so if you're interested in attending, if you've never been to an event before, certainly reach out to me. We're trying to manage this event as more of a private invite. So we want to make sure we're connecting the right people in the industry without over-congregating at this point. So if you're interested to attend, please email info@joinclab.com and we'll make sure to get you to that event. And if you want to find out more about C-Lab, certainly check us out online at joinclab.com. So with that said, sorry for the self-promotion. I want to turn this over to our moderator for tonight, David Ron with S2S Insurance. David, thank you as always, and I will turn it over to you.
Thanks, Rob. Good evening, everybody. And tonight's discussion is going to be exploring alternative risk solutions for the cannabis and hemp industry. Does your risk management cover unique risks? My name is David Ron. I'm Vice President of Account Services of S2S Insurance Specialist, a bespoke insurance agency dealing with the coverage surrounding the hemp, CBD, and cannabis industries. Our topic tonight, exploring alternative risk solutions for the cannabis and hemp industry, is an advanced conversation about alternative insurance products. Alternative risk insurance products are common in many industries. It's when traditional insurance premiums become overpriced, create higher deductibles, decrease in limits in coverage, and become or experience high loss ratios. We call this the hard market in the insurance industry. Hard market should make you pause and consider, why am I paying all this money for insurance when we've never had a loss? Coverages such as directors and officers liability, product liability, and crop insurance coverages have been subject to these hard market trends as our industry moves forward. Because the cannabis industry is in its infancy, a young industry, state regulated and federally penalized under the 280 IRS code, our industry faces challenges that no other traditional businesses encounter today. The webinar today is going to take a deeper dive into what alternative insurance products are out there that may be beneficial to consumers. I'd like to now please join me in welcoming our distinguished panelists for this evening. We have Kevin Haller, CPA of Aking Consulting. Kevin is both a California and Oregon CPA and understands financial reporting and internal controls. His passion for the cannabis industry allows him to bring solutions to the pain points businesses face in this industry. Next, we have Rocco Petrelli, Chairman of the National Cannabis Risk Management Association. Rocco, in addition, serves as the Chief Operating Officer of Attender Insurance, which is owned by the constituents of the NCRMA. A 30-year business executive and veteran of the automotive components and manufacturing industry, Rocco has extensive experience in all aspects of global and multinational business planning and development. He also serves in many roles as risk management and talent optimization, achieving multiple team victories in more than a dozen business startups by creating the proper structure and organization to ensure continuous improvement. Last but not least, we have Eric Ron, Managing Director of Ron and Associates Insurance and C-Lab board member. Eric is an experienced insurance broker in hard-to-place coverages, domestic and multinational companies operating in state and federally regulated industries. Eric has held many executive positions in the maritime and casino industries, and he has transitioned his knowledge of corporate business practices into becoming a top insurance producer by working with C-suite executives into becoming on evaluating cannabis risks, providing alternative insurance solutions for multi-state cannabis operations, and developing risk mitigation strategies that exceed client expectations. Gentlemen, thank you for joining us this evening and welcome to C-Lab. Lastly, I'd like to thank our host and organizer for the event tonight, the Cannabis Lab. The lab stands for Law, Accounting, and Business. C-Lab focuses on our true audience, the professional services sector, including business owners, investors, entrepreneurs, financial services, accounting, law, insurance, marketing, public relations, and the like. Think of us as the lab that infusing professionalism into the cannabis industry. If you are committed to the cannabis industry and you want to know who you need to know to become a resource to your clients in your own business, or if you want to continue, then we created continue your knowledge in the cannabis industry. We created Cannabis Lab for you. Welcome. We invite you to grow healthy, grow wealthy, and grow smarter. So let's begin. Eric, I'm going to start with you. In many cases, insurance companies will simply say, we cannot cover a particular risk. Can a captive insurance product provide this coverage?
So like all new industries, captives are new to the cannabis industry, but the short answer is yes. A company can transfer risk to their own captive insurance company and get reinsurance to take the higher limits on that insurance company.
And how does one go about applying for a captive insurance program?
Well, that's a much deeper dive that requires your captive advisor, your team of captive advisors, and that could be your insurance broker, your accountant, your attorney, and your risk management team, internal risk management team. So forming a captive is time consuming, it costs some money, but in the long run, you're going to come away with a risk management strategy. And I'm sure you're going to hear a lot more about that tonight.
Great. Kevin, Eric just brought up accountants becoming part of this captive insurance team. You deal a lot with the 280E tax code. Can you tell us a little bit more under 280E, how is insurance classified?
Yes. So just a quick recap, 280E, ultimately, you can only deduct cost of goods sold. So really it differs depending on if you are a reseller or producer. So resellers would be like a retailer or distribution company. Generally, they can only deduct cannabis product that they buy. If you're doing any packaging, that could be in potentially labor, but for the most part at the reseller side, insurance would be a below the line SG&A and therefore not deductible. However, producers, since they're cultivators and manufacturing, a lot of their costs go into creating cannabis and processing cannabis into manufactured products. You could potentially allocate certain insurance costs to cost of goods sold. Under 471, ultimately, the language that they use very often for 280E is that deductions must be incident to and necessary for production. So, for example, property taxes on your facility where you're producing cannabis could be allocated to cost of goods sold, and potentially workers' compensation insurance for employees that are part of the production cycle, but not the employees that are part of your administrative support function.
Great. Rocco, I'd like to give you the opportunity to kind of elaborate in tell our audience what the NCRMA is and what can it provide for cannabis businesses?
Yeah, thank you, David. It's a good front story to the subject of captives, and I'll tell you how we got there. But I started out in this initiative over 3 years ago with the primary purpose of creating an association that would bring risk management to the cannabis industry. As you said in your introduction, I did spend 30 years in automotive components manufacturing, and the last 10 or 12 years I was served as a CEO of various companies, and always considered making sure that my company had a bulletproof risk management strategy was my biggest and most prevalent responsibility. And you may think, well, what is risk management in automotive components manufacturing? And the example I can give you is, if one of my plants was supplying a component that went into the engine that services the Ford F-150, and they didn't build engines today because of either a quality problem or a delivery problem associated with that part. My bill was $500,000 a day. So that's some pretty stiff risk, and you have to have some pretty substantial risk management strategy behind you to protect you from that. And I became interested in cannabis and recognized that cannabis could greatly benefit from much of the risk management knowledge and education that I had picked up in my career. So we started the NCRMA, which stands for the National Cannabis Risk Management Association. And as of today, we still stand as the only association dedicated to cannabis risk management in the Americas. And we've greatly expanded the portfolio of disruptively innovative risk management products by creating an academy that basically brings to the table an educational curriculum that is defined by our members to address what they have defined as the biggest risk in their business, and also by the development of a SaaS-based risk assessment tool that allows us to go into our member companies and perform a rather thorough risk management that results in the creation of a scorecard that could then be used to develop further educational curriculum recommendations or consultation for our member companies. So we're very, very pleased at what we've created, and we're very pleased at the early reception that our industry or that our association has gotten in the marketplace, because we're recognized for a couple of things, and one is the fact that we're responsive, which is extremely important to us and one of our core values. But also we're highly respected in terms of the integrity that we bring to the party. And the real design was then to use this risk management foundation, which is truly, the foundation of which insurance is attached to, and take it to the existing cannabis insurance market, and come together in some type of a collaboration where the insurance companies that were in the space would start to offer our members fairer, more fairly priced, and also better coverages for their various cannabis businesses. But early on in those efforts, I was sort of stiff-armed. I mean, I'm an ex-football player, so I'm usually the one giving the stiff arms, but I was stiff-armed, and for that reason, we felt that we had to come up with an insurance solution for our members, independent of working with the existing market. And that led us to the path of forming an association captive that's owned by the NCRMA, that truly has risk management as at its foundation. So what we do is we combine some of the management advantages of a captive, like enforcement and control, and we combine that with an innovative risk management platform to create a best in class of insured. And the people that control the capacity in the marketplace tell us that the bigger group of best in class that we can grow from an insured standpoint, the more capacity they'll open up. So that's our mission going forward.
That's amazing. It's so nice to see somebody coming from, ideally the same industry, but really being on both sides of the spectrum, being on the C-suite side, purchasing the insurance, and then also creating a company that provides the insurance for the client. I think that's amazing, being on both sides of the coin like that. With that being said, I'd like to open up this next question to both everybody here. It seems there are so many different types of cannabis companies, and also there are different types of captive insurance products out there. Can Eric or Rocco or Kevin, can you maybe help us with our audience in trying to match up the different types of captives, how they would work in different places in the cannabis industry, different sectors?
Who wants to take it?
Eric, go ahead.
First, alternative risk solutions or captives are not for everybody. And there are different forms of captives. There's what's called a Series A captive, which is or a parent captive, which means you own that captive 100%. There's also shared captives or cell captives, in which you can actually rent a captive that's been formed for a short or midterm period. There's also called risk retention groups, and I'm going to let Rocco explain that a little more, because I think it's more in line with what he's doing. But let me give you a real life story about when and how and what you should do when looking at a captive or evaluating it. So I had in 2017 a multi-vertical, multi-state cannabis operator. And at that time, the client was paying $146,000 for their D&O policy with a $25 million limit, and had a $75,000 deductible. The next year, in 2018, that primary D&O went for $125,000 for $1 million of coverage with a $125,000 deductible. And they were only able to secure $7.5 million of excess, which cost them $650,000. So they ended up paying $775,000 for about $100,000 per million in 2018 for only 8.5. In the prior year, they had 25. I think you're going to start seeing where this is going. In 2019, the company's board of directors decided they weren't going to spend this money, because in 2019, the same coverage for $8.5 million was now $1 million with $1 million deductible. So they decided to reduce their D&O coverage down to $1 million and paid $150,000 for that. And what happened? 2 of their board members immediately resigned. This company now has cycled through 6 CEOs, and the board is now frantically looking for solutions for their D&O, because now they can't go back to the market to raise more funds to grow the business. So at what point, as a CEO, do you put your hands up and say, you know what, I'm not going to pay for this. I can't pay this anymore, but I need it. So you're between a rock and a hard spot. that's when you start looking at alternative risk solutions.
And one of those alternative risk solutions being a captive. So Eric, before we move it over to Rocco, can you just give us, for our audience, just maybe a clear, well-defined answer of what a captive product is?
So a captive product is when your company or your investors and shareholders form a captive, a separate company that is now defined as an insurance company. And you do this by hiring captive managers who place the business in a captive forum and is licensed by the state in which the captive is licensed. And now all of a sudden, what premiums you used to pay to an insurance company, you may pay for some of your traditional coverage and continue that, but you're going to transfer the risk and premium of the hard to place policies into the captive. And what happens is you're self-funding and betting again for yourself. In other words, instead of that expense being an annual expense, now it's an investment. You own a captive, you own your own insurance company, and it is now funded every year by you to help cover your losses and buy reinsurance, which is much cheaper than buying excess coverage in the open market. What happens if you have a loss? Well, your captive managers review the claim and they'll pay it out of your accumulated capital in the captive and any reinsurance levels that you have to take the upper limits of your risk. In addition to that, your captive is part of a pool of other captive companies. And that's where the transfer of risk happens. So what happens is, in our particular program, the company retains 20% of the risk and 80% goes into the pool. So now you're part of, let's say, 100 captive companies. You're only responsible for 20% of your risk claim. But you're also responsible for your pro rata share of that 80% of risk within that pool. So what your goal is in setting up a captive is, one, understand what insurance is and what you're really buying. And second is you have to have a strategic plan, a risk management team, and a well-structured and defined strategic objective. What are you trying to achieve? What risk are you trying to transfer? How do you build better internal controls to control your risk management, as Kevin alluded to? Do you have a compliance officer? Are you committed to good governance? Do you have buy-in from the board all the way down to your line supervisors that are going to buy into your risk management program? Do you have prudent funding? Again, captives are not for everybody. It's mostly for companies that have accumulated revenues and have revenues to invest in themselves into their own captives. And finally, you have to have a long view here. If captive view is five to 10 years, but as you're owning your own insurance company, after the first 2 years, after you've built up retention, you can then start working on reducing your premiums because you've already have built-in capital in your captive. So I hope that answers the question.
Yeah, no, thank you so much. Just bringing it back over to you, if you could just elaborate a little bit more on risk retention groups.
Yeah, well, first let me start. I mean, we took a look at it, and by the way, Eric, very well articulated. It really is a confusing science. The captive model that we've adopted at the NPRMA is actually an association captive, which is more like a mutual insurance company. So even though the policyholders have a basic say into how the companies run. No particular policyholder exercises control of the company. That's exercised by the association.
Interesting. Okay.
And there's times when the policyholder may be asked to vote on matters regarding. But what's key here is that because there's really no upfront investment, as soon as the insurance ceases, so does the policyholder's ownership status. So the policyholder never invests in any of the assets in the insurance company and doesn't actively participate in running it. There's pure captives that are invested in, run, and owned by the insured. And then there's other captives that maybe they're insuring one particular market, but they're owned by people in other markets. And we felt simply those are called sponsored captives. So we felt that, given the fact that we already had the foundation of the NCRMA, that the association captive, which is, a pure captive, because it only insures the risk of its owners, was the best model to follow. And how that differs from a risk retention group is a risk retention group. The fundamental difference is that a risk retention group can only assume liability exposures on behalf of its members. So where our association captive is set up to, for example, rate coverages in property, in workers' comp, in auto, risk retention groups are limited to liability exposures like GL premise, like D&O, E&O, and some of the other coverages that Eric was defining. In a risk retention group, I believe the members have to be engaged in similar activities. So if you form an RRG around cannabis, and I know there's a couple out there that are forming, of course, all the members have to be involved in cannabis, and they also have to have ownership interest in the particular captive that they're working to. So there's many different types, many different forms, and many different domiciles for these various captives. And as Eric says, it takes a lot of time and effort, and it also takes a lot of cash to research and choose the right one and then establish it effectively.
Just to add to Rocco's comments, if you're interested in looking and exploring captives or alternative solutions, our recommendation is you get involved with a captive advisor who's going to help you do your own internal feasibility study. And from there, there's a checklist of items that you run through almost by every department within your company to see how well you're set up and in compliance, and how you treat your various risks. And that feasibility study will help you determine what type of captive, risk retention group, association, it's going to help you educate yourself on what is the best avenue for your company, for its size, for its long-term growth and capabilities. And just last comment is, once you form these captives, can you get out of them? Am I stuck? And the answer to that is yes, you can terminate a captive. Various programs have certain rules, and it varies state by state, depending on what you do in that state and what's done in that captive. So I would always put that on your list of questions when getting a proposal. Although this sounds all great and good in the long term, what happens if we get acquired? What happens if we sell the business? What happens if we go out of business? What happens if we outgrow the original scheme that we thought 2 years ago was good and now, we need more? So these are all the things your captive advisor can help you analyze, and then also help pitch to your board and to your internal management team of what needs to be done to get to this next level.
Eric, and just to add to that, to spin all the way back to like Captive 101, because obviously our audience is made up of different people, and this may be the first time they're exposed to this. I like to differentiate a captive, with all these fancy categorizations and definitions by really two things. And number one is if you buy your insurance from a public insurance company, and they have a positive loss ratio, which means they collect more money in premiums than they pay out in claims. Typically that ratio runs about 65%. So the money that's left over that isn't chewed up administratively by the operation of the insurance company, it goes to stakeholders and shareholders. In a captive, it comes back to the membership. And in an association captive, the design is that we bring it back in terms of fairer and lower premiums, as well as better and more customized coverages.
And in addition, once you get your captive going, let's say you're down the road 3 to 5 years, there's enough capital in there to pay your premiums every year. It just keeps rolling over.
That's right.
So it's almost like an insurance, an annuity once you get a well-defined captive.
Yeah, and that's why, and the other point I was going to make, that's why risk management is so important, particularly to a captive, because, we're not talking about massive assets. So your long-term stability comes from an upfront risk management curriculum that drives that loss ratio down and builds that surplus. And the higher you can build that surplus, the more stability you'll build in your insurance products. And that's what's not happening in cannabis today.
Yeah. And again, every company is different. Some companies have a high burn rate in a specific category. Let's say property, for an example. Well, instead of putting that property policy into your captive, you would just buy your traditional property insurance, but buy the lower limits, and then have excess property within your captive to take care of any catastrophic event.
Right.
And so what we as captive advisors do is we look at all your policies, we look at all your loss history, and the problem we have in the cannabis industry, and I think everybody around the table will agree with it, we don't have a lot of data yet. The only thing we have is we've seen a lot of D&O claims come out of the early days. We have some product liability claims we've seen in the vape industry, some edible claims, some property fires. Obviously, we've had crop insurance is something that, if I was in a state, we had a healthy hemp organization, I would get that organization form a hemp associative captive and all join and, help each other out here.
Wonderful. Thank you so much, gentlemen. Kevin, my next question is for you. And I thank God it's April 15th, or else I wouldn't be asking this question because it's tax day. Kevin, what sort of tax ramifications from a cannabis company standpoint? Should they form a captive or transfer a majority of their insurance premium from a traditional program into a specialty program like these captives or risk retention groups?
Yeah, and I want to preface, I'm more on the assurance side of things, doing financial services, but because cannabis taxes are such a big deal, I definitely know enough to speak to them. So I'm not as busy as a lot of my counterparts on today. I think the most important thing that we're kind of touching on here is we're in probably the most risky industry today, dealing with something federally legal, dealing with a lot of gray area, dealing with the fact that we can only deduct cost of goods sold. So I think what's best about this is to work with professionals to start assessing risk and seeing where you can put things in buckets, how you can allocate certain insurance up to cost of goods sold, looking at and exploring whether a captive, or like Eric said, are we going to just insure this piece and move this part over into a captive? I know a question was brought up whether there's deductibility for premiums paid. And ultimately, yeah, the IRS has laid out, rules under which captive insurance constitutes insurance for federal tax purposes. So they do have certain structures. Premiums can be deductible, but again, because we're talking cannabis, it can only be insurance that we're basically saying is an inventoriable cost. Various benefits can be is reduced premiums, right? Because now instead of paying, an insurance company's, margins, you can kind of self-insure a bit with others. And so, you have tax deductions for the parent company. However, under, 280E and some court cases, like with alternative healthcare advocates, they kind of broke down the complex structure. So you have to really look at, do we have a captive over here as part of this structure? And does that make that entity subject to 280E? Because here's this whole umbrella of entities that are plant touching. And so they kind of look at your overall structure as well. But there's various other tax savings, like there's distributions to captive owners at favorable tax rates. There's asset protection for claims that could protect business and personal assets from creditors. So again, I think it boils down to, in this industry, you have to assess and manage risk more than any other industry, because there's great reward, but we have compliance across the board at federal, state, and local levels. And it's best to start working with professionals to understand the various risks out there and how you plan to manage and mitigate those risks.
I just wanted to add to Kevin, captives also allow for international companies with US exposures to be formed. So we do a lot with the Canadian RSO public companies that have either operations both in Canada and the US, or basically went to Canada to raise their money and are a Canadian corporation with US operations. So some of the cross-border issues become a little more simpler in a captive than along some of the traditional lines of, where can you buy your insurance for your cannabis company? Do I have to buy it in Canada, or do I have to bifurcate that, buy some in Canada and buy some in the US? It gets complicated.
Yeah, very. And there are risks with it. I mean, if you're in a pool, you're also at the mercy of what others do within the pool, right? And we know in this industry, we've seen, like, for example, during the pandemic in Oakland, there was a lot of targeted theft and robberies done, and, insurance claims with fires and everything. So you have to really understand, I think it's important to look at insurance in different buckets and figure out what makes sense potentially in a captive to save money, right? Because the best medicine for navigating 280E, in my opinion, is not trying to play the shell game with costs in different entity structures, but how do you save money and optimize your top line? And if you can save money with certain insurance vessels through a captive, that's the key to navigating 280 successfully while being compliant. And so I think it's just important that everyone just, you work with professionals in there to find out all kinds of ways to optimize cost savings, and more so making sure you are covered should something happen. Because I've heard a lot of horror stories of, individual businesses thinking they're insured for certain things and then finding out that they're not. So you definitely want to work with cannabis experts in the space. And still, like you said at the very beginning, Eric, there's not much information out there. So a lot of us, it's just through what we've learned over the years. And there is still a lot of gray in this area, right? And even with like how we're allocating certain insurance to cost of goods sold, there's gray in that. And what it comes down to is having solid internal controls, documented justification for what you're doing, and trying your best to tie it back to section code so that you can demonstrate under audit or different, scrutiny from regulators that, you are doing your best to be compliant and follow the rules as they're laid out.
Great. I have one question that I'd like to propose to all three of you. Please, I welcome any response. Looking into the future, do you see cannabis companies, hemp companies, taking this sort of approach with alternative insurance products? And where do you think that they're most necessary?
Well, I'll start. I think the practices of what I'll call the public insurance market today, combined with the uncertainty around federal decriminalization, is going to, for example, like some of the instances of premium costs that Eric explained. I think it's gonna force people in that direction. In order to just get the types of insurance that, number one, they can afford, or number two, they can or that they deserve. So, but again, it's sort of an easy answer, right, David? Do we expect it to increase? Yeah, because there's not a lot of activity right now. It's just a question of how much it'll increase, and I think that's going to be based a lot on the feds, and then when big insurance enters, what path they decide to take.
I also think as time marches forward and, we happen to see what happens with the Safe Banking Act, and if that gets approved, or, I think the next couple of years is going to be very interesting for our industry. But when I look back on it, again, alternative risk solutions aren't for everybody. I think, for those who have been successful and have made money, this is a good alternative to look at. I also think if you look at D&O and E&O for the medical practices, I think the price of D&O is only going to go up. It's actually harder to get D&O. So what it does is it raises the bar of entry into our industry. If you want to go public or raise outside money from investors. So all these things, of all the things running out of control, D&O and product liability seem to be the two that, people are having problems with.
Yeah. I mean, if you're in this industry as an operator, you're already, open to accepting risk, right? I mean, we're talking about something federal illegal. It is the gold rush of our time, and that's why there's a lot of capital and people jumping in here, because we all know there's a lot of opportunity, and this is a huge industry, and it's bifurcated into several different segments that are just at its infancy stage. And so it's going to go through a lot of pain points. I mean, the fact that you're dealing with something where there are some banking solutions, but limited, and you're dealing with a high cash volume industry, and the risk associated with a product that has a lot of value and cash in there that just makes it susceptible for theft is a big deal. And, we've all heard horror stories of individuals with backpacks of $100 grand walking around to try to, take it to its next location. That's going to change. And like Rocco said, the uncertainty, are we going to legalize? Are we going to reschedule? Are we going to deschedule? All have different outcomes potentially on how the industry will evolve. But, we're talking about something that's on a global scale evolving in a huge way. So, people are always going to get creative to try to find out what's the best way to give me a competitive edge. And that's ultimately through having solid processes for assessing and managing risk. And that's cost savings, optimizing top line. So I do think there's going to be a lot of exploration in here, especially because a lot of components might not be insurable. So captives can kind of bring and get you some insurance in some areas that you might not be able to find elsewhere. So I do think it's going to be explored quite a bit in this industry in the time coming.
Excellent. I'd like to take this time to open up questions to our audience. Does our audience have any questions for our wonderful panelists? Please type them in, and we look forward to seeing them. Eric, you're on mute.
I hope we didn't put everybody to sleep.
Fascinating stuff.
Yes.
We have a question.
All right.
No, I'm sorry. That was one of our colleagues just trying to ask us something else.
I see.
Why? I guess we'd like to take this time and thank you for our esteemed panelists for taking the time to discuss new and exciting opportunities for the hemp and cannabis businesses looking for alternative risk management solutions. I'd also like to thank our wonderful audience. Of course, if you have any additional questions or would like to connect after the discussion, shoot us an email and I will make sure that I can connect you to the right panelists, or please put your information below in the chat and I'll be sure to direct your question to the right panelists. Lastly, I'd like to thank our brilliant organizers. B-Lab, thank you for giving cannabis professionals a forum to grow healthy, grow wealthy, and grow smarter. My name is David Ron, VP of S2S Insurance. Thank you. Enjoy your evening. Wonderful evening, everybody. Thank you, gentlemen.
Thank you.
Thank you.